Hello, how you guys doing? Hopefully, everybody here had a wonderful Thanksgiving and a great holiday. As you guys know, my name is Mark Monroe. This is Real Estate Power Play Podcast. If you're listening to us on any of your favorite podcast platforms, please like us, share, comment, or if you're watching to us on any of the social media platforms, please share, like us. But today's episode is going to be a great episode. Where when you're watching this, we're coming into Black Friday, if you will, and we're going to be talking to Josh and Brent. And Josh is a CPA, and we're really going to be talking about the end of the year tax planning. So you want to be able to prepare now to do what you can try to do to get all your income or move around or to prepare for your taxes before you have to go into the new year, and try to catch yourself ahead of time. So, Josh and Brent, welcome, guys. Josh, how you doing?
Doing well, thank you. Thanks for having us.
I appreciate you guys being on. And Brent, how you doing as well?
I'm doing good. Thank you. Thanks for having us. I think this is our third or fourth event we've done together. So thank you again for the invitation. Look forward to speaking with you and educating the audience here.
Yeah, and this is what this is all about, providing value to everybody in the real estate world, really in anything, but we really focus on real estate since majority of the people are listening on real estate. But but you can actually reach out to Josh as well if you have any other questions outside of real estate. And I know you guys do a lot of business because I've referred some business people, people like Dan. Well, Dan's actually in the real estate world now too, but he had a Amazon store at one time, doing quite a bit of stuff. So, and I know you guys also, besides CPA doing work, you guys also have a couple other services because I referred and you guys help out setting up asset protection trust and creating entities too. Why don't you talk about that briefly, Brent?
Yeah. So we're a full service incorporating an accounting asset protection company across the country. We primarily focus, we do a lot of entity structuring in states like Nevada and Wyoming for privacy purposes. We're going to talk a little bit today about taxes. And for the most part, you pay your taxes where you live or where the asset is or where you may have employees. But there's a lot more that comes into business structuring when it comes to really setting yourself up for the future, setting up your family, the legacy that you want to leave, and then also the protection that you have when it comes to proper corporate structuring. So we look at that piece first when clients are referred over. As Mark mentioned, he's referred over several clients. I mean, we already work with a ton of clients from this real estate group, from the core, from different groups that he's been part of. But we look at that structuring and really identify, are you incorporated? Are you headquartered in the best state? Because just because you live in Maryland or Pennsylvania doesn't mean that you have to have your company set up there. So a lot of people don't realize that. So we'll look at that kind of as a company as a whole. Where are they structured? What does their tax situation look like? And then ultimately, we're working, Mark's spending time on this podcast to educate people. You guys are spending time listening to the podcast to really grow your wealth and your portfolio. And after that's all done and we have that day of judgment, then what's going to happen? And we want to make sure not only our clients structure properly and growing that wealth and saving as much money as they can year in and year out, but they're also in a position to leave that to their spouse and to their children and grandchildren. And so those are really the three areas we primarily focus on: is corporate structuring. We set up C Corps, S Corps, partnerships. We do all the type of corporate entities that you can imagine. We do have the ability to form them in all 50 states. For example, we have a doctor who just came to us from California who needed a professional corporation. So we can help outside of those states I mentioned, but we will look to see if it makes sense to have that base foundation in a state that protects you, that really gives you that brick wall, like literally brick wall. Here's your personal life, here's your business life, and keep that separate. And then once you have that proper formation in place, that's where my team, my partners come into play, like Josh in our accounting department, to really identify, should your corporation be taxed as an S corporation, or should your LLC be taxed as a partnership or an S corporation or a C Corp? There's a lot of different there's some flexibility that corporations and LLCs offer, and a lot of people aren't aware of that. So we provide that education. We do spend a lot of time with our clients. We're very unique as opposed to other accounting firms or H&R Blocks or some of those companies where you go in with your numbers at the beginning of the year, you put them on a table, and you're basically paying taxes off what happened the year prior. Make sure that if you are in that position and you're concerned about your structure, or you have a lot of profit that is going to be left over at the end of the year, what are your options? What can we do for you to minimize that risk and tax liability before December 31st? Because once December 31st comes and goes, there's nothing that we can do as a company to help you. And so we look at that as a whole to make sure that you're in the best position possible. And then again, I will work with my clients primarily on the structuring and the asset protection. Mark, I know I'm helping you with your trusts, and I've helped a lot of the clients with the structure and trust. And then ultimately, once we bring them on board for the accounting and that tax planning, that's where Josh and his team come into play to make sure that you guys are in the best position possible.
That's perfect. Great intro. Thanks so much. And
Thank you.
let's now, thank you, by the way, for you guys helping me out with my stuff. So I really appreciate it. And the customer service you guys have been giving has been phenomenal. So thank you for that. So Josh, let's just jump into it. Let's dive in and let's talk about a little bit of tax planning. So what do you think, like, in the real estate world, what is the number one thing that will pop into your head that real estate investors mess up and they always have to wait another year where they can try to go ahead of time and plan it now? What do you think that is for the number one thing?
Number one thing that they mess up with is, one, not keeping good financials. That's always a big issue, right? Not knowing your numbers until after the year, kind of what Brent was mentioning, that if you don't have your financials in a good position where you're kind of making it up last second right before you file your taxes, it's difficult to make decisions before the end of the year. So that's one big issue where I see, and one big deduction or opportunity that may or may not be known is depreciation, right? As real estate investors, when you own rental properties or whatever it may be, taking that depreciation can be a huge thing. And one add-on to that we often recommend for our clients is a cost segregation study. And those cost segregation study, for those who don't know what it is, essentially when you purchase a building, whether it be commercial or single family residence, you typically divide that purchase into building and land, and the building is depreciable over 27 and a half years for residents and 39 for commercial, and the land is non-depreciable. Now, the cost segregation allows you to break out that building portion into smaller aspects that may be a 5-year depreciable life or 7-year depreciable life instead of the 27 and a half or 39 year. So that creates a big opportunity for clients. For example, I had a client whose net income was over $1 million, and we were able to bring that liability down by a few $100,000 by doing a cost segregation study for this individual. And his tax liability went from about $300,000 down to $50,000. So he was very happy by getting that cost segregation study done. And that's one big opportunity that many real estate investors have by investing in real estate. Now, there are some caveats. It's not something that is kind of everybody can do it, because there are some things that may restrict you. But that is a case-by-case basis where we can look at it and analyze it and see if it does qualify for your situation.
And Josh, if you don't mind me jumping in, Mark, on that, on the cost segregation, that does take us a little bit of time to complete that study. Right now, we're looking towards the end of November. Roughly, how long does it take us to run that report and to finish that cost?
So it can take a few weeks for it to get completed. The good thing with the cost segregation study, it does not have to be completed before the end of the year. And in fact, if you have a real estate or a rental property that you've had for years, we can actually use it on a property that's been in place for several years. So we don't have to do it on the year it's purchased. It doesn't have to be done before the end of the year. It has to be done before you finish your tax return. So, but I would definitely recommend getting it done earlier than waiting till the last second, because I had some individuals who were trying to get it done last second near the extension deadline, and it wasn't able to get completed in time because they waited too long.
Interesting. Now, how does that work? Like, say, for example, and I've heard, cost segregation is awesome, especially in the multifamily world. It works really well. How does it, like, if, say, for example, does it make sense that if somebody's gonna be selling the property like within like 2 or 3 years to be able to still do the cost segregation, or if they've already owned it, like, say, for example, they've owned it for a few years and they never did cost segregation, but they're going to be selling it in the next couple of years. What are your thoughts on something like that, Josh?
So that would come down to what your current liability will look like. For example, if you're at a 37% federal tax rate for the current year, and in the future, you may be at a 20% tax rate, it could make sense to do that cost segregation this year, decreasing on the 37%, because you're going to have a gain later on when you do sell it. So if it's really close in the years you're selling it, it may not make sense if you're going to be in a similar tax bracket, because yes, you'll save money now, but pay more tax later. because that depreciation, that accelerated depreciation, is an add back depreciation, not as capital gain always. It would be added back as ordinary income, which is often a confusion that people have. They think it's going to be added back as a capital gain, which is capped at 20%. So it really depends on your individual situation and what your tax is going to look like this year versus what you predict it to be in the future.
Got it. That makes sense. So so if you're taking a big chunk this year versus possibly you're not sure about next year, it makes sense trying to do it this year versus. So that's kind of what you're saying.
Yeah. Going back to like for 2023, for example, if I can create $100,000 in depreciation by doing a cost segregation, and it's going to save you 37%. So you're going to save $37,000. But next year, let's say you sell it, so you're adding an additional $100,000, but you're only at a 22% tax bracket. You're only going to pay $22,000 in tax. So you netted $15,000 in tax by doing it this year versus next year, or not doing it at all, I guess.
Awesome. I like that. Now let's talk a little bit about especially in a lot of these people that follow, they do. We buy a lot of properties through seller financing strategies, and we sell through seller financing strategies. So let's talk a little bit about that. And I know it may be off topic a little bit about tax planning, but it would be really beneficial to people listening. But before I jump to that real quick, I want to go back to the depreciation, and I will talk a little bit about seller financing. The depreciation, I see a lot of people, and anybody listening to this, if you're just getting into real estate or if you're not in real estate, you should really pay attention, because I know people that have other income, their 9-to-5 jobs, and they're doing extremely well with income coming in. So they have to buy properties for the depreciation to offset some of that tax. So you want to talk a little bit about that, Josh?
Yeah, and that is a great opportunity to help cut down on your taxes. And the one caveat there is there are certain thresholds you have to meet to become a real estate professional, making sure you're hitting that hour requirement, being a material participant, because if you're not hitting those, and this is going to get a little more on the technical end of it, where the rental properties typically default to a passive investment, meaning if you have a loss on a rental property, it cannot offset your W-2 income is what you're getting at, unless you're under a certain income threshold or you're a real estate professional. So once you become that real estate professional and hit that status, then it can offset it. So if I have a $100,000 loss because of this cost segregation, it can offset $100,000 of my W-2. But if you're not hitting that real estate professional status, or if your income's too high, then those losses from that cost segregation may not help you, because it just might carry forward because you're not considered a real estate professional. So keeping track of those hours is really important.
Yeah. Do you know what the requirements are?
So real estate professional is 750 hours in the real estate industry.
How many? You cut out how many hours?
750. So you have to have 750 hours for the year. And it also has to be more than half of anything else you do. So for example, myself as a CPA, it would be tough for me to be considered a real estate professional because I spend a lot of time doing taxes, things like that. I'm not really in the real estate industry, where you're developing, I deal with real estate related clients a lot, but that doesn't count towards a real estate professional, unfortunately. So I wouldn't be one to qualify, because even if I did spend 750 hours, I'm not spending more time than I do on taxes, if that makes sense.
Got it. Okay, that makes sense. Brett, did you have a question here or anything before I go to my next question?
One quick point I want to make in relation to that is a spouse. So let's say, for example, my spouse doesn't work. She can make that real estate professional status because she doesn't do any other job. She can just hit that 750 hours, and then she can meet it for both of us, because only one of the spouses has to meet that hour requirement. So that's one way around that real estate professional for somebody who does work in an industry that may not be real estate related.
Okay, that's huge. I'm sorry. Brett, did you have anything that you wanted to say or ask a question or anything?
Nope. Not on that one.
Okay, cool. All right. So back to my other question there about seller financing. Can you tell me a little bit, and the listeners, and it may not reference to tax planning in general, but overall, like if we're talking to a seller and they have a property and they're willing to do seller financing and carry the note or whatever, how is that, because that's the biggest thing, like these investors, like how can they talk to a seller saying, oh, there's tax advantages of doing seller financing versus just selling it and getting hit with all this? Is it, when they sell it, is it considered capital gains, or is it what kind of taxable bracket does it do it? You want to talk a little bit about that, because it comes up a lot in our world of doing real estate and doing real estate strategies.
Yeah, no problem. So one good thing with seller financing is it allows you to control the timing of your gain. And going back to how you were asking me whether it's good to take a cost seg this year if you're going to sell it in a few years, kind of the same concept where if your tax rate this year may be extremely high or in the next few years maybe extremely high, doing the seller financing allows you to control that and mitigate that gain in terms of how much you're going to pick up each year. Because normally if you just sell it and you're not doing seller financing, whatever you sold it for, less what you paid for, less the closing cost is your gain. And you pick that up in the year you sell it. Now, if you're doing the seller financing, you may have that same gain, but you pick it up as you receive the money. So if you're receiving that money over time, 5 years, you're spreading that gain out over 5 years, which could decrease your tax rate significantly depending on how your tax situation is.
Got it. So their tax gain, and how do you determine that? Like, because I've heard different stories. Is it considered ordinary income? Because sometimes ordinary income could be a higher tax. Is that correct versus gain taxes?
Yeah, and it goes back to how they depreciated the assets. So if they took accelerated depreciation, there could be some add back at ordinary as well as then the rest of it would be at capital gain. So, or, depend on the seller themselves without looking at their actual depreciation schedule. It'd be tough to answer that, but it could be a combination of the two. It's not just one or the other. Typically, most of it's going to be capital gain unless you took a lot of accelerated depreciation.
Got it. So back to the scenario I was mentioning about 10, 15 minutes ago. So back, if we're doing a depreciation on a property, right, and they're going to sell it within the next couple years, if they sell it, consider seller financing instead, maybe with like a 5-year balloon or something. So they're so the taxes are being done over like those 5 years, and then the big at the 5th year. You want to kind of explain that a little bit?
Yep. Yeah. So, and I'll just use some generic numbers. So let's just say the gain would have been $100,000. Okay. And you did seller financing and you received 10% of the total payment that you're due in the first year. So then you would pick up 10% of the gain that year. So you pick up $10,000 as income that first year. Then let's say you receive 10% the next year, you pick up another 10,000 and so on until the 5th year, like you're mentioning, you're receiving a large balloon. So let's say you receive the remaining 50% in the 5th year, then you're picking up 50% of the $100,000 on that 5th year. So that's how that would work. It's a percentage of your gain, or it's a percentage of the amount that you're supposed to receive times whatever your gain is how much you're going to record as income. Now you would also be charging interest, so that interest during the year would also be taxable for whatever amount you're receiving as interest income on that seller financing.
Got it. And what is that? What is that interest considered? What kind of tax is that called, or what
It's
do you guys
ordinary.
categorize?
It's ordinary income.
I'm sorry.
Ordinary income.
Ordinary income.
Yeah.
Got it. Got it. So that makes sense. Is there any advantages for tax purposes besides deferring the taxes? You pretty much don't get any really tax credits or advantages because you're making income off of it in a sense, correct?
Yeah, there's not really the biggest advantage, like I said, is being able to control the timing. So you're able to control what year, you can receive that money in order to pick up that gain. So if you, like I said, if this year you're having a large amount of income, or the next 3-4 years you're having a large amount of income, and in 5 years from now your income is going to be significantly lower, you may try to work with the buyer in that case to receive a large balloon in 5 years when you think your income will be lower and at a lower bracket.
Okay, that makes sense. And I've also, I had another business in the past where, and we can talk a little bit about this. So a lot of times what we tend to do is like, we'll go ahead and order a lot of things in December, products, whatever it may be, to kind of have the expense. So you can kind of get, I know it doesn't really work a lot in the real estate world, but have you seen that where people go ahead and order extra inventory that will carry it for a little while so they get some of that tax down? Or have you seen that before?
Yeah, maybe not inventory specifically, because if you are tracking inventory, it may not be deductible at that point. But yeah, supplies, equipment, things like that, where you can take a bonus depreciation or 179 depreciation on them, or that they're just expensible in general. Yeah, that's a good way to cut down on your taxes. There are some other tax strategies. So normally, for example, let's say your tax bracket is 25%, and you go buy this piece of equipment for $10,000. That's going to save you roughly $2,500 in tax, right? So that's the concept, is to decrease your tax. Now, there are some strategies that we can help you set up, such as an Augusta tax rule, or other tax planning strategies that may be more beneficial, where the cost to set that up may be close, let's say $3,000-$4,000. Let's just go with 3, but it could save you potentially $9,000 in tax. So in this case, you're getting almost $300 on your investment, right? It's costing you $3,000 and you're saving $9,000 in tax. Whereas compared to the supplies or equipment, you're spending $10,000 to save $2,500. Does that make sense? So there are other things that may be even more beneficial than just buying supplies or equipment or things like that.
So that's great. The Augusta rule, I didn't even think about that. I knew about it, but I didn't think about that trying to plan for the taxes, year-end taxes. So that's good. What else do you recommend? Any other type of tax strategies that you guys recommend?
Yeah, I mean, there's a variety of ones.
Real quick about the Augusta rule. I think the Augusta rule is something that really needs to be looked at with each client, because like Josh said, the potential savings there and the amount of conversations I've had with people that have been referred over. I mean, it's something that most business owners take advantage of, but the people that have been referred over who qualify for it, it's really kind of amazing what those numbers look like. How many people have never had the conversation, didn't know about it, and potentially saves you a ton of money, where you could take that money, pay yourself, put it in your personal account, like Josh said, potentially save $9,000. We will, as a company, and most companies will, because there's a difference between a deduction and saving a receipt or keeping it on an Excel spreadsheet, or actually taking advantage of some of these tax planning strategies, which Josh will go over the second one here in a second. But like with the Augusta rule, for example, there's compliance forms, there's meeting minutes, there's things that you need to do to make sure that you qualify for it properly. So with our clients, we want to make sure that, yeah, you know about it, that conversation has taken place, and then what is required for you to actually take advantage of it. Some people will just put it on their tax return and hope that they don't, ever have that knock on the door or receive a letter. And at that point in time, they're scrambling sometimes to put it in place. It's better to just be proactive. Know that, like Josh said, you're saving $9,000. It's going to take a little bit of time to implement this strategy, which we help our clients implement, because we don't want to have something be temporary in anything in business. And if it's saving money on taxes, where it's a temporary loan that you end up paying back with penalties and interest or whatever because you didn't do it properly, we don't want that with our clients. So we will break that down to go over, this is what's required. This is what you need to do in order to qualify for it. And if you do qualify for it, it's a huge tax savings. I love the country we live in. I love the things that we have. Taxes are part of the things that we have to pay, but I'm not going to pay more personally. Josh isn't, Mark isn't. We're not going to pay more than we have to. So we look at that to see if you qualify, and then lay out that game plan to make sure. And that's why the timing of this is so important. Again, we basically have between now and the end of the year to make sure that that type of strategy is implemented. So,
yeah.
Now, why don't you kind of explain what the Augusta rule is in a quick snap?
Yeah, I'll go through it, and I'll answer your question about the other, any other things that may be applicable. So the Augusta is a loophole in the tax law, which allows you to rent your house from your business to yourself personally. It's not the home office. It's different than a home office. Like Brent was mentioning, there are certain compliance and legal documents and certain things that you have to be done in order to make this a legitimate deduction. And I've seen people just write themselves checks trying to do this, and it's not done correctly. And either we can't use it, or I've seen them get audited because they didn't document it correctly. So that is something, like Brent's mentioning, we do help you with, and get, all the minutia documents done. That way you don't have to worry about it. You're getting your tax savings, and making sure it's a legitimate deduction. But yeah, to answer your question, Mark, it's in a simple sense, it's you renting your business, your home to your business. If you meet certain requirements and document it correctly, then it creates a pretty large deduction that can help you on your taxes. There are other things, and each situation is different, right? The Augusta, theoretically, we can almost implement with anybody, but because of the cost to implement it, it may not make sense, or because going back to the real estate and how passive rentals are typically passive unless you're a real estate professional, it may not make sense for you. Because it may not save you money on your taxes because you're not considered a real estate professional, because it can't offset that W-2 income or active income. So we do look at that to make sure it does make sense, both financially for you, because you don't want to do it. You don't want to pay $2,000, $3,000 to get it set up if it's going to save you $1,000, right? That doesn't make sense. We want to make sure it makes sense for you. Everything, all the I's are dotted and T's are crossed, and make sure that we're setting that up. Now, there's other things such as hiring kids. Again, I've seen people just pay their kids, and it's not as simple as that. There's certain documentation compliance you need to happen. So we look at all that for it. We look at cost segs. We look at whether it be looking into a larger retirement plan, a cash balance plan, where you can look at potentially a few $100,000 putting away into a retirement plan per year. We try to look at every scenario that may be applicable for your situation, tax credits, tax deductions. And sometimes there aren't anything, and a lot of times there are. So we like to look at each individual situation, and everybody's different. Everybody's situation is different. And so it's tough to give a blanket answer for everybody, but we do our best, and I'm constantly looking for different things or loopholes that we can implement for our clients to help them save taxes and help myself save taxes, hopefully. So,
and
I like it.
Piggyback on that. I mean, one thing that we've offered Mark to do with you and your group, and I mean, just the success we've had with is to have these conversations. We'll review past tax returns. We'll want clients to send those in, have those conversations, kind of do a breakdown. And then what I do on my side with my other, with one of our founders, and then my partner's wife, who we basically handle all of Mark's clients, is we'll review. I call them clients. I mean, associates, referrals. We'll review and take a look at that and kind of get with our accounting department to say, hey, what do we see here? Is there anything at all? We try to have that conversation, and just because, again, if it doesn't make sense for you to switch, if you're doing everything you can, you have a good relationship with your CPA or accountant, I'm a big believer. If you like your dentist, doctor, mechanic, you can stay with them. Obviously, we'd love to have your business. We do specialize a lot of different areas. We have great relationships with Mark, but we'll look at that and say, hey, this is definitely something that we can look at implementing. You certainly would be in a position to qualify for that. Not that we like spending that time prior, but we are willing to do so to kind of look to see if it makes sense for you to switch, or we'll be the first one to tell you your accountant's doing a great job. I was on a call last week with one of my other partners who basically, and it was a huge account. It was a potential, $1,000 of business a month where they would need help with all the accounting, bookkeeping, potential tax help. And we were the first one to say that this side of what your business looks really, really good. There's not much more different we can do. However, we do include the taxes with our clients when we do the accounting and bookkeeping throughout the year. So there's some benefit there now, where when we're doing the bookkeeping and the accounting, we're helping with the quarterly estimated tax payments. We're kind of looking at it throughout the year as things are trending, what the projections are. So we don't have to have these conversations the last 30 days of the year, but maybe start having those conversations September, October, so you can plan for it. And we're not that last second situation. But that is the approach, and that's the commitment that we've made, to just look at it, see if it makes sense to switch, answer your questions. And obviously, for the most part, when they come from a group like this, that's part of Mark's podcast or part of the core group, and we've had really, really good success making them a client and starting that relationship. But at the same time, there's no commitment. It's just more of does this make sense? Are you looking at everything? Let us take a look at it, and then we'll go from there. And that really is our approach. It's not, high pressure. It's just a conversation like this, whether it's on a Zoom call or a phone call, or you come in house, we'll sit down and we'll break it down, be real with you, and say, this is what you're missing out on, or things look great. Keep moving forward.
Yeah. So definitely, you guys are great. It's going to come from a lot of different sources. Even in the seller financing community, we got about 86,000 of you guys out there now that are listening to this. So definitely reach out. We put the phone number here. What is it? 855-767-1977, 855-767-1977. So no matter where you guys are listening to this, definitely reach out to these guys, Brett and Josh. And one of the things that really was a key point why I wanted to go with you all is, and I thought this was valuable, is that whenever I had I needed a question regarding my from my last CPA, sorry about that, he would charge me $130 an hour. And even if I was going to be on a phone call with him only for 25, 30 minutes, I will still bill the $130. Where with you all, you guys recommend, we reach out like a couple times a year to evaluate our taxes. And that was one of the biggest things that I was really a big factor of why. And plus, you guys are in the real estate world. You guys know real estate as well, and you guys invest in real estate. So I think that was probably one of the biggest things in your customer service. I can't. This customer service is great. So anyways, if everybody's listening, you guys want to know more about, your tax planning or anything what Josh was saying about, setting up asset protection or creating a new LLC. And we recommend doing that. I know we didn't really get into this topic today, but if you're having quite a few assets, you want to have several different LLCs. You don't want to park all your assets in one LLC to kind of diversify a little bit on that. So that's another whole conversation that we can have. But you guys, if you're listening to this, definitely reach out to Brett, because Brett, you guys can talk about. I know that's one aspect of it, but that's something I see a lot of people doing is they'll own like 10, 15 properties and they'll have them all in one LLC. And what are your thoughts on that, Brett? On that?
Yeah, I mean, if you know the saying, I mean, it's cliche. If you have all your eggs in one basket, potentially you can have those, taken from you. So we'll look at it to see, the property, what state it's in. Some states allow series LLC, so we may be able to set up one LLC and separate those 10 properties and still only have, one tax return or one renewal with the state. So, it just depends on where you're at. But yeah, I definitely agree. Now, if some of the properties are a little lower income, not a lot of profit, I don't have a problem with you maybe putting a couple in there, but it's definitely better to separate them. And then also, as Mark mentioned, is, we've talked about the trust. Sometimes you can just have a very simple structure, maybe 2 or 3 LLCs, even with multiple properties, and then have a trust in play. And then that will complete the structure. And then you don't have to have, like one of my good friends in Wyoming, his name's Carl. He has 64 entities, and his CPA tells him every year, because we actually don't do the taxes, but we do all the LLC formation. We work with his team. And he told him it's kind of overkill, but that's the way he was set up from the beginning, and he wants to keep it in place. Whether we're doing your taxes, whether we're doing LLC creation, Mark brought up a very good point. When we started our company, the thing that we couldn't stand is when we sent an email to an attorney or to someone and it was billed in 15-minute increments when literally they type back, yes, that's correct. Very frustrating. It all balances out here. When you first start, we need to get to know you. So we're going to obviously spend more time with you that first year or two, but it all balances out so our clients could benefit that. They don't feel like they're getting nickel and dime. We offer you a price to set up an entity. I'll tell you right now, entity creation, full service from start to finish, EIN, we're cheaper than LegalZooms and some of those online services where people think I can go and get it done cheap here. Well, that's only if you want to form a name. We get the EIN. We'll help you with the operating agreement, the minutes of your meeting. Behind me, I have a bunch of record books here that I keep my main clients here. And then we have a bullpen area where we keep track of all of our clients' documentation. So, I mean, I had a lady earlier who was literally at the lender, and don't do this to me too often, but she didn't plan. She called me at the last second. She goes, I need this operating agreement done right now. And so literally, I helped her recreate her operating agreement from 2019, which had all the same information, and then showed that this was done then, and then she signed it. But we literally are always there, willing to help. You won't get billed, whether it's trust service that we complete for you, whether we're doing your taxes or the corporate structuring. We just believe that, you offer that support, you give a price. And to be very candid, we're very proud of this. I'm sure Mark's proud of his portfolio. His group's grown every year. Our company's grown every year. And that's for a reason, because we offer that service. We try to have that relationship with our clients.
I appreciate it. Josh, thank you for your time. I really appreciate it. So everybody that's listening, Josh, Brett, you guys can stay on for 1 second while we close out. And again, thank you guys so much for being on Real Estate Power Play podcast. If you like us, please share. If there's an episode that you want us to kind of talk about, or if you want to be on as a guest, reach out to us. So thank you guys so much, and enjoy your holiday weekend all. Take care.